All right, guys. So today is day 20, and we'll be talking about something very important, and that is the interest rate differentials, right? It's a very, very important topic, and it's something that I have used to understand where the market should go on the long-term perspective, right? So let's talk about interest rates. You know, when you talk about the Forex space, the interest rate happens to be the most important driving force from the fundamental standpoint, right? So let's look at interest rate differentials, right? Interest rate has so many things here. We have interest rates when you're comparing it to you know bond yields and all of those functions, right? But for this teaching, I will not be talking about all those ones. I'll just go to the straight one which you can easily understand, and that's the interest rate differential. The interest rate differential is something actually learned from the inner circle trader, ICT. Something I've used to be able to know the overall direction of the market, right? Interest rate differential will help you to know the long-term movements, the swing movements, or the future projection of a particular currency pair, right? Please, if you have not watched the previous videos from day 1 to day 19, do out to watch all of them before coming here because it will all make sense when you have watched the previous ones, right? So let's talk about interest rates now. The interest rate is the most important driving force in the financial markets. When the interest rate of a particular currency pair is high, it will tend to be, attract investors. Let's assume that we have two banks now, right? Assume that you had $1 million now, right? Imagine you had $1 million, right? You had $1 million, and the bank of the American bank, right? Let's say the American banks, right? Or let's say the US banks I give you an interest of 4% per, per month, right? Imagine that the US bank are giving you an interest of 4% per month, while the um, Japanese bank are giving you an interest of what? 1% per month, right? Assume that there are two banks now, and you had $1 million, right? And you wanted to invest your $1 million. The US bank is giving you 4% per month, while the JPY bank is giving you what? 1% per month, right? Now, if you look at these two rates, which one would you go for? It's likely what? This one, because the interest rate is what? Higher than that of what? The Japanese bank. So you would want to invest your money in the bank that has a more favorable interest rate because you're going to make more returns. 4% of $1 million is a lot of money. I think 4% of $1 million is about $40,000 or thereabouts, right? So you're making $40,000 per month compared to making $10,000 per month, right? So you would likely go for what? This one because the interest rate is what? Higher. So that is the same thing that applies to the currency market. Whenever the interest rate of the currency is high, that currency tends to attract a lot of investors, right? And if that currency attracts a lot of investors, that means that currency was bullish, all right? It will be bullish until inflation sets in. So the interest rate is used to regulate the inflation, and it's used to do what? To attract investors to a particular economy, right? So now, what does this mean? This simply means that if you have a currency like USDJPY, if you have a currency pair like USDJPY, right? So USDJPY would be what? It should be what? Bullish, because the US banks are having what? A bullish interest rate. So people will be betting on the USD against the JPY. That means USDJPY will be what? It will be bullish because in that sense, the chart was bullish. Because why? The interest rates of US is more attractive than what JPY. So people will be betting on the USD against what the JPY. So on the long term, you will see USD doing what? Going upwards for the long term. It will be a long-term upward movement because of the interest rate differentials. And you want to be trading currency pairs that the interest rates are quite different, right? You don't want to be trading pairs that, like, let's assume that maybe you're seeing an interest rate of, let's say, if you want to hold the trade for a long time, you don't want to pay that maybe say US is what 4%, and then let's say JPY is now what 3.9%. The interest rate is not much different because they are very close, right? So you want to trade in the pairs when the interest rates are very different. So you can be able to project to the future what the market should do on the long term because the interest rate between US now and JPY was almost the same. So you want to be trading when the interest rates are what having was a positive or sharp negative differential. I want to see that the difference is what much. Right? I want to say the difference is what much. Difference between one currency pair and the other currency. So between one currency and the other currency, right? So that's it. Simply how this is just a simple definition on how to identify and how to understand interest rate. You look at what the interest of the different currencies, look at the history, and then you're able to project from the long-term perspective what the market should do. And then you combine it with what the market structure of the market to understand what the market should do from the long-term perspective, right? So now let us do another example now. Let us assume that another example now. Let's do another example. So let's assume that now we have another pair. So we have another pair now. Let's assume that maybe we have a pair like this. Let's say the Euro Bank is giving what 4% a month, right? And let's say the NZD, the New Zealand dollars, is giving what 9%. Right, this is how the pair is now. Euro Bank is giving this, and now you now see a currency pair that looks like this. A pair like Euro NZD, right? You now see Euro NZD. Which direction do you think the pair will go? Now, Euro Bank is what 4% a month, while NZ is what 9% a month. What direction do you think it will go? Obviously, what? Bearish, right? Because the Euro Bank is less than what the NZD Bank. So the direction of this pair will be what? Bearish. So the interest rate was negative. The interest rate between these two pairs was negative. So it was negative movement. So you look at the base currency and try to identify what the base currency is doing, right? So the direction of this particular pair was bearish, right? So the overall direction was down because this currency, the differential between this and that is negative. Why this was positive? So positive should go up, why negative should want to go down, right? So that's the difference between Euro and NZD. So you look at the interest rate and compare the pair that is being treated, right? So now we have understood this. Let us now go to rate chart examples and understand this from the rate chart. Now let's look at a very simple pair. Now you come to this pair, you come to this site. The site is globalrate.com. So you come to this site, you click on interest rates. So this is usually you're coming to do it. You click on interest rates on this pair. And then you click on central banks, right? So click on central banks to know the interest rates, right? So you click on that and then you come there. So these are the interest rates for each currency. You can see that with the American bank, you can see the interest rates. The current interest rate was 5.5%, while the previous one was what? 5.25%. And the change happened on the 27th of what? July. So on the 26th of July. I know this was the last time an increased interest rate on the 26th of July, right? So now let us look at it. Let's look at GBP AUD, right? What has been the interest rate of GBP? The British pound interest rate has been what? 5.25%. And the last change was what? In the month of I think that is February, if I'm not mistaken, March, if I'm not mistaken. And if you look at the history of interest rates, you can see that right from the year 2022, the interest rate for JPY has been going up. You can see that it's moved from 1.25 in April 2022, 1.75. You can see the thing has been going up for the past last 1 year, right? So that means JPY was bullish, and the interest rate of the interest of the British the British, which is GBY, GBP. So the answer interest rate of GBP is what? GBP interest rate is what? GBP interest rate is what? 5%, I think. Is it 5%? Let me check quickly. 5.25%, right? So 5.25%. So I have 5.25, right? Now I want to look at AUD. The moment we're considering AUD, GBP AUD, right? We'll look at the interest of GBP AUD. So now let's look at it again. So let's look at AUD. Australian dollar is what? 4% currency. Let's go to the history. Let's look at the history of it. So the history of Australian bank has been what? Has been going up, but relatively, it has never gone higher than what? Than the what? It has not gone higher than what? The G the GBP, right? It has not gone higher than the GBP. That is the direction. It's not gone higher than the GBP. All right. So let's write 4%. So AUD interest rate is what 4%. Right? AUD is 4%. Right? And has never gone higher than the GBP. So that means if we compare these two pairs, you can see that the GBP is what is more positive than what AUD. So that means we anticipate an overall what bullish movement, right? Because the GBP is more bullish than what AUD. So that means the GBP is stronger than the AUD on the long term. So you expect what a movement. So when did that happen? Right from the year 2022. So let's look at 2022 up to now. Let's look at 2022 up until now. So we look at 2022 and see how this line happened. So let's go to 2022. Let's go to 2022. Which month was that? Let's start from this is October. So let's start from around October last year. Let's look at October last year. October 2022. All right. So can you see what I'm talking about? Can you see that overall the direction for this pair has been was bullish? At least October last year. Can you see what I'm talking about? We have been what relatively was bullish because of the interest rate that was bullish. So you can see that this is not guesswork. Right? So if you are seeing this, then you have been targeting, okay, the market should come to this liquidity region here. So have liquidity up here. You have been buying all these markets, buying. Maybe after this market structure shift. So if you saw, you have to combine this with market structure. So after this market structure shift here, we had was a break of structure here. Market broke structure somewhere around there. Right? We had that BOS here. And still that BOS, we tapped into was this imbalance. This imbalance was hit. We hit this imbalance here. All right, this imbalance was inside there. I don't know why it's not letting me draw it. Give me a moment. Let me just get it. Sorry. All right. So we hit that imbalance there, right? We hit that imbalance since the market has been was bullish. So if you are buying from here, you have been just targeting previous highs, liquidity, and then this overall liquidity there. And the market is still very bullish. So looking at GPAUD, I still expect the market might still go higher. Right? You can still see more bullish price move because the interest rate is still bullish, right? So we have to wait for what a market structure shift. And I think we have one here because market has done what has broken this high. And then now we are expecting what this imbalance here, right? So market can still go was bullish. So starting the market drive up onto this high here. So this high will be an area of interest, this high first, and then this consequence. So you can see market drive up onto this high. So this will be a target for GPAD. This is about the interest rate that still was bullish, right? So that is how to anticipate. You have to look at market structure and then combine it with what you have on the given pair, right? So that is it. So let's look at another pair, the last one, and then we'll call it a day for this call. Let's just pick a pair, just a random pair. Let's pick something like let's pick a pair like NZD-USD. Let's look at NZD-USD, right? So let's look at NZD. So NZD interest rate as in what? Let's go back and look at NZD interest rates. New Zealand dollars. New Zealand, right? New Zealand. Okay, so okay. 5.5%, right? Let's look at the history. The history of the New Zealand Central Bank interest rate, right? It has been relatively bullish, 5.5% for NZD. Let's write that down. So 5.5% for NZD. Wow. 5.5% for NZD. So let's look at USD now. Why for the USD? Let's look at USD interest rates. That's the American bank. So, sorry, that's Australia. American bank. Yeah. The USA is what's also bullish, and it's also at 5.5%. Wow, this is interesting. Right? 5.5%. So US is at 5.5%. Wow. This is going to be a tug of war because this market is not really different. Right. So we're having similar interest rate on these two given pairs. Right. We're having similar interest rates. Let us consider the interest rate for these two pairs have been relatively what? Relatively similar. That means that most likely you might see the NZUSD not very pronounced in movement, right? The direction might not really be so one-sided. It might just be a kind of range, right? So expect some kind of range because the interest rates are very what? Similar, right? There's no strong differential between the two interest rates, right? So that means you might see NZUSD move in a kind of ranging movement, right? And although you can always look at market structure, if you're not quite sure, you can always use the market structure to trade it. But I feel that the movements for this pair would not be so one-sided. It will more of be in a kind of range. Right? Let us just confirm that quickly to confirm what I see. So let's say NZD USD, right? So we're wrapping up now. This is NZD USD. And then look at the last pair and then we'll come to the. So this is NZD USD. You see that the market has been a kind of range. It's not really been smooth. Right? You can see that the NZD USD for the past 1 year, it has been up and down. Right? You can see that since October last year, this October, the market has bought and then also what sold. So it has not really been so one-sided, right? So in this kind of scenario, you cannot use the market structure, but use based on interest rate. You can't really tell what the market is going to do only on the interest rate. You just use what we call the market structure. So in this scenario here, you just introduce the market structure of the market. Just use the market structure to trade it. And you can also consider other what other fundamental aspects apart from interest rate, right? We have what we call the bond yields and all of that. So for this scenario, the market, you can see that the thing was just so rangy, just up, down, up, down, up, down. You can see that the market has been ranging a lot because of the similar interest rates, right? For this scenario, you cannot simply use market structure, right? Seeing that the euro dollar has been bearish, or you can use what we call asset correlation, right? If you're not really sure of the interest rate of a particular pair, you can use what we call the market structure and that. So let's just look at one last pair. For this scenario, they had a similar interest rate. So you want to focus on pairs that have quite different. So let's look at the last pair, which is what the GBP, let's see Euro GPY. So for the Euro, let's look at it quickly. So for Euro, the Euro bank, what is the interest rate of Euro? Let us quickly run through that. The European bank is what? 4.5%, right? So 4.5% has been the interest rate of what? The European bank, 4.5%, right? Euro is what? 4.5%. This is the last one. Please, you can get the Profem blueprint with the link in the description, right? You will see the video pop up very soon. Just get that for so you can have access to what I have for you guys. All right, so let's look at that. Consider the European market was bullish and its current side was 4.5%, right? Let's look at the Japanese bank, which is what GPY. So Japanese central bank is what? Minus 0.1%, right? So let's just write that Japanese bank is what? Minus 0.1%, right? Minus 0.1%. So GPY was minus 0.1%. This is negative 0.1%. That's been the interest for Japanese bank. So if you look at this very carefully, and the history is what? It has been negative for the past 20 years. It has never gone above. It has been, since 2016, it has been 0.1%. So it does not change. So the Japanese interest that is bearish. I mean, if you put your money in the Japanese bank, you'll be actually taking losses instead of profits. So if you look at these two pairs, that means the overall direction of what EGB should be what bullish. right? Should be bullish because Euro is was bullish, while Japanese was bearish. So there's a very good differential here. So let's look at Euro JPY. It's very, very easy to predict that it was overall bullish. But that doesn't mean you cannot see bearish action, right? It doesn't mean you can't see bearish action. Let's look at it. Can you see? Can you see it? The market has been relatively bullish. Can you see? Let's look at this. Right from 2019, the market has been what? Bullish for the past 4 years or 5 years. Or yeah, although we had a kind of retracement from here, but from here we had was bullishness. Market has been bullish ever since then. You can see that it's very easy to tell what the market will do on the overall term, and it's very likely the market will take out this high. So expect GPY, EUJPY to take out this high, right? So that's what we're ending this talk for today. I don't want this call to be so long. That is how to predict what the market is going to do on the long term using the interest rate. So you always have to combine market structure, combine the overall interest rate, and then you can know the higher time frame movements of the chart. You can now mark your key levels, your weekly levels, your liquidity levels, when the market should go to, right? So for this market now, if you are buying this, maybe somewhere around there, I'm targeting what this high here. This will be your high of target. This high, you are target buying to take out this liquidity high here. This high right there. So this will be your target if you are buying this on the long term. So if you are swing trading this, you can buy and targeting with that high. Market actually hit that high. So all this will be what opportunities to add more buys. Just adding more buys, and targeting with this high. So that is how to identify what the market should do on the long term perspective, right? So all this call was insightful. I wish you guys the best of the trading week. Don't forget to plug in tomorrow, and I will see you guys in the next teaching. So have a wonderful day. Cheers and God bless.